and welcome back to another episode of the Smart Money Show. My name is Naman Akhtar, and as usual, I'm joined by Ali Suleiman. How are things, man?
I'm good. I am fresh off finishing my summer internship at the time of recording. I'm gutted it's over, to be honest. I really, really enjoyed it. But obviously, it was a blessing to even have the experience. And yeah, I now focus is on smashing 30 and graduating with a first. How are you?
Yeah, fine. I mean, just about your internship though, like it's 6 weeks, but it went by so fast. Like the first week was there, then next thing you know, you're on week five, and then of course now it's finished. But you have made me jealous by your whole corporate life. Was I've been sat at home, but in my second year, then that's when internship cycle will be for me. So so slowly prepping towards that because as you guys know, the summer internships open around like July, August, September period. So just prepping your technicals and whatnot for any career in finance is essential. But anyways, we're not here to talk about our summer internships because we've got a very, very valued guest today, don't we, Ali?
100%, and it's something we've had in the diary for a long time, and me and Naman have been so eager to speak to him. So today we are of course joined by Michael Seigne. So a little bit about Michael before we jump straight in, as we usually do. So he is a seasoned execution specialist with over 3 decades of experience navigating global financial markets. Across a career that spans investment banks, agency brokers and market makers, Michael has held senior leadership roles, including but not limited to, of course, managing director at Goldman Sachs and global head of execution services at Redburn, where he built a reputation for combining market expertise with integrity and precision. In 2022, Michael founded Candor Partners Limited, a mission-driven firm that works with listed companies to improve outcomes in share transactions, with a particular focus on optimizing the execution of share buybacks. His vision for Candor, which we'll get into more, is rooted in a deep commitment to fairness, transparency, and efficiency in capital markets. But beyond the trading floor, Michael has contributed meaningfully to both industry and academic thought leadership. He has co-authored multiple research papers with a professor of finance, published by the Harvard Law School Forum on corporate governance and Columbia Law School's Blue Sky blog. His insights have also been featured in the coveted Financial Times and been used by the Financial Conduct Authority. Michael's story is one of long-term excellence, professional conviction, and a genuine desire to improve how capital markets serve both companies and shareholders. So without further ado, a very modest intro for someone who is probably one of our biggest guests so far. Michael, how are you, and welcome to the show.
Well, thank you very much for having me. I think that intro was the best I've ever had. Slightly overstating what I've been doing. I've just been working. But very excited to be here, and thank you for having me. And yeah, should be a lot of fun to chat.
Well, you've been working hard. I think that's an adjective I can add to that. But anyways, I think we should just get straight into it then. So, of course, as usual, we cover a few topics, but then we always like to begin with our background and early influences, just to get like a picture on who Michael really is, because that's what we're going to be exploring in this episode. So, Michael, a brief question, if you don't mind me starting off, Ali.
Yeah.
What was your upbringing like, and did anything early on hint for you ending up in finance?
So I had a very, I guess, normal or unusual. I don't know what backgrounds are like, but I grew up in a family of 5 kids. My dad was a medical doctor, and my mum was a a full-time mother, in terms of she was probably the hardest working person in the house, but not for income. And we sort of transitioned around a little bit because Dad, when I was born, was working in America, although he's Irish. And then we moved back to Ireland when I was very young. But then he couldn't earn enough money to get us schooled and stuff, so he went back to America. And we had this sort of funny setup where my dad was working in America, still married very happily to my mum, so he would commute back and forward from America to Ireland. So it was quite unusual from that perspective. So every summer holiday we would go over to America. But I have zero background in finance at all, and in fact had no interest in finance in any way, shape, or form all the way through university, and even when in my first job. It wasn't until later, when I had no idea what I wanted to do in the future, which I would imagine quite a few of your peers have that sort of, what do I want to be? I had no way of seeing that future because as a kid, I always wanted to be a medic. And I tried to get in medical school, failed, repeated my leaving certificate, which is your A levels over here, failed again, and ended up doing engineering, not because of any desire to do engineering particularly, but just because the top 7 choices I had were all medical schools, and they all said no. And the 8th choice was engineering, because that's what I put on a list in Ireland. You list your choices 1 to 10 in those days on a form, and that's why I ended up with. I can't even remember why I put engineering on the form. So it's slightly weird from that perspective, but a very, very happy, healthy childhood, which is a great foundation. If anyone's privileged enough to have that, I was lucky.
Yeah. No, amazing, and thanks for that answer. I mean, we always like, as Noman said at the top of the episode, we always like to kick off with a question in that vein, just because we think it adds frame to a picture that we're trying to paint throughout this episode. So, you said that you didn't have that interest in finance. So, what was that? I mean, even if there was there a particular moment that really sparked your interest in, markets? Is for me.
Yes, but it was very much later. So, I did my engineering course, of which it was very arduous. I had a fantastic time in university, but not studying. And it was a different era in those days. It was playing rugby and being very social and all those sorts of things, and getting by in university. I had to repeat a few exams along the way. I'm not particularly academically gifted. Ironic that I would write some. Well, I've only written one academic paper, actually, technically, because in order for something to be called an academic paper, it needs to be peer reviewed. I've written a lot of white papers, but so be it. But I wouldn't, and I've got some version of dyslexia, although I've never officially got myself checked out or anything like that. So I definitely would never, I would never have been accused of being a good student in any way, shape, or form. But when I left university, I ended up in Hong Kong for a different story. I'm happy to talk about it if you want. But anyway, I ended up in Hong Kong, and my first job was in Hong Kong. When I say first job, I mean I did a lot of work as a kid, as summer jobs and all those sorts of things. But I mean my first, career job, if you like, and that was in engineering. And the reality was I wasn't interested in what I was doing. And I had that sort of moment where I looked, at what my boss did, what my boss's boss did, and I was working in an excellent engineering firm. I was looking up at what do they all do, and absolutely none of it inspired me. It was just dull as dishwater from my perspective. I'm a person who's fascinated by solving problems, but I'm not fascinated by the iterative problem down to the nth degree of solving problems in that sort of sense. I've got a very much an engineering type brain, but I like to solve a big problem, if you know what I mean. But once you get down to, okay, well, that's how you do it, making it actually work is a bit dull in my world. But I was living in Hong Kong, and it's just a fantastically expensive place to live. And I was getting paid £8,500 a year. This is 1992, that sort of time. And just for context, the average rent in Hong Kong, as soon as I worked in my professional role in financial services, for my flat was about £30,000 a year, and I was earning 8. Just give you context in terms of something which you can sort of go, okay, how much does this cost? So it was very, I was not living in a nice flat or anything like that. Not that I deserved it, but there's that context. So it was a financial need more than anything else. It was like, I've got to get out of engineering. I'm not interested in it. I can't see myself, and I can't really survive. So I needed to move. And then you look around, and in those days in Hong Kong, the major thing that a lot of people did who were, a lot of jobs were around in financial services. So I looked there.
Wow, no, very, very interesting. And we know that that's kind of how you started. I mean, looking at experience, which we'll let you bring up when you'd like to, but looking at your experience, we know that's when trading really hit, was when you first joined the financial services sort of industry in Hong Kong. So yeah, no, that was a very interesting answer. And at the end of the day, some people like me and Naman are planning to go into it since we were students, right? But some people fall into it, and to know that you didn't plan for it, but it's worked out in ways that I'm sure you can never have imagined is what's the word I'm looking for, is quite inspiring, I think, for someone that is trying to plan so much, you know what I mean?
Yeah, and I'd assume, and probably most of our viewers as well, when they click on this episode, would be that okay, it's a story of someone getting 4 marks at the A level, I guess, level, and then going on to uni, studying their first choice course, going straight into banking, doing a summer internship. But this is actually really, really eye opening and I guess inspiring at the same time, because we know that your story continues on excellence. So that is actually really, really interesting. But then I think one last question on this section. So now, of course, you beyond this now, when you're in Hong Kong, you wanted to pivot towards financial services then. So could you just talk more about that, and then like more about actually breaking into the industry? What's your thoughts on how maybe it's changed over time as well, maybe?
Yeah, I mean, it's changed a lot, and the situation I was in was also very, very different insofar as Hong Kong in those days, and I don't know now. I still have quite a lot of contacts and family who live out there and work out there, but I don't know how it is to get a job out there at the moment. But in the time that I was trying, I didn't really know exactly what I wanted to do. What I'd done is I'd left engineering because an Irish friend of mine had also come over and worked in a separate firm in engineering. We'd gone through university together, and he had left engineering for fairly similar reasons and gone into something which optically looked like it would pay well, which was in financial services, but it was called what would now be called an IFA, an independent financial advisor. And in those days, what you were selling is you were selling some version of a forced savings scheme dressed up as either a pension fund, a pension savings plan, or an annuity plan for paying off a mortgage or paying education for children or those sorts of things. And they were um, very attractive products from the perspective of the seller. So they were not good investments from the perspective of the purchaser, but it wasn't very transparent. And so the deal was, if he could recruit people into the company, he got paid £3,000, which was a lot of money, is in those those times specifically, and from the lens I was looking through. And he said, "Look, I tell you what, Mike, I'll give you £1,000 of the 3,000 if you come." And I was like, "Okay, well, I've got nothing better, nothing more exciting to do. I'll go and do this." So that's, I mean, random walk stuff, right? How I ended up in that world. And then they sent me back to the UK to do some training program, which was really a cold calling, forced selling, not structured selling type programming, like for to try and you know write your script for cold calling and all those sorts of things, and how do you go and go about sort of gathering a client base and that sort of stuff. But it was a 2 week, give you an idea of uh, how sort of thinly covered this topic was. It was a 2 week course on, so not great depth, virtually nothing on financial services at all in terms of what's good and what's bad. It was, here's the products, here's how you sell them, that sort of stuff. And I did that for about 3 months. And after the first month, you had to start to pay for your own seat in the company. So it was really structured around aggressive selling. And after 3 months, I had my first big sell, and I sold this or big sale, whatever you call it. I sold this savings plan to a professional who worked in a very big U.S. company. Probably wasn't very tax efficient for the person, but in the way these structures were sold, if you got the client to tick boxes like, would you like this thing to be a 12-year plan or a 24-year plan? Yeah, it was very advantageous to me as a salesperson to get it to be a 24-year plan. So you were taught techniques as to how to do that. The guy was happy, he ticked the box, and I think he was saving $1,000 a month for 24 years. And I got paid up front, in that process, 1 year of his first year's contributions. And for ticking the box to go to 24, it became 2 years of his contributions. So you do the maths on that. It was $24,000 was what I got paid out of that process, and that's what came to me, not my company. It was, and as soon as that happened, I realized this is not good. This cannot be good. Hadn't really registered before that, and I went, I've got to get out. So I then spent the next 2 months intensively interviewing. And because of the way the structure worked within the company, they cared how many calls you were making, how many meetings you were going to. And I just set up the process. Never forget, I was paying for my seat. So, it didn't really matter. They would like me to have been working on selling, but I didn't feel remotely like I owed them anything. And I spent the next 2 months working incredibly hard to get a job. And the way that you did that in those days was everybody you called, so long as you had some soft introduction to them somehow or other, pretty much everybody would accept a coffee. Can we go for a coffee, and can you talk to me about what you're doing? And that was the way that, and I thought that the way that I would sell myself in terms of a potential hire to a company was that I should focus on my background in terms of what did I bring to the party. So I have a version of a maths degree. It turns out it's not a maths degree, but at the time I thought it was. And I'm a civil engineer. So I thought, well, Asia is going through this huge infrastructure boom. So Hong Kong was building a new airport. He was building new roads, all this, and quite a lot of this stuff. In a Hong Kong situation, it was being funded by the government, but the rest of Asia was doing an awful lot of infrastructure, which was being funded by investors as opposed to necessarily government funding. So I thought, I would combine the sort of my knowledge of, knowledge. I was a 2-year engineer, not a lot of knowledge, but my knowledge of, engineering and engineering projects and finance in terms of maths. So the mathematical side. So I was selling myself as a sort of like, hey, I could go and work in structured finance for or equity derivatives or fixed income derivatives for infrastructure related products. That's what I thought. And I went for a whole series of interviews, and I clearly remember Bankers Trust was one of the big banks in this sort of space, and I managed to, through playing rugby and stuff like that, managed to get a meeting with somebody on the trading desk in the equity derivatives guy desk, and he sat there and said, "So, Mike, what's a call option up front?" And I'm like, "Well, I know what an option is. It's." I said, "What's the difference between an option and a future?" Ah, completely stumble. Had no idea. Within 3 minutes, he was like, "Okay, maybe this wouldn't be suitable for you because in those days, if you didn't have a textbooks, you didn't have access to information. Like the internet wasn't really what you would know as the internet now. There wasn't any wiki finance or anything like that. So I just completely flunked all this stuff, and you know, I I think I had 30 different companies interviews because of this sort of process in 30 days, that sort of idea, and then multiple interviews within each company if I got past round one, that sort of process, right? And I ended up being offered jobs by two companies. One was HSBC and one was Goldman. I mean, talk about unbelievably fortuitous luck and all these sorts of things. The HSBC job, both of them were in FX. Again, I just about knew what FX was, but I'm not kidding. I did not know what GDP meant. Not kidding, right? I'm an engineer. You were taught what GDP was in, and I got offered, two jobs. Goldman were desperate because their junior foreign exchange trader was basically getting on the plane to go, and foreign exchange spot, which was what you would buy and sell if you go to an airport, as opposed to forwards and all these side of stuff. They were looking for a junior spot trader, not a trader, but basically sandwich boy to the traders, like a junior to run around and on the trading side. And HSBC was looking for a junior sales foreign exchange person. I didn't need interview for foreign exchange. Bizarrely, right? But this is kind of, and I think it was my sporting background, if I'm totally honest, and the fact that I was, a walking, talking Westerner, which might sound awful, but I mean, at the time, the desks were staffed with. I think that's what did it. But the guys I worked with and I ended up taking the job in Goldman. Bizarrely, I wanted to take the job in the HSBC, but somebody said, Mike, like, you're being offered a job in Goldman. What are you thinking? I didn't know who Goldman was. I mean, genuinely, I mean, it sounds incredible, right? But I wasn't really exposed to finance in any way, shape, or form. But we're in Hong Kong, and you've got HSBC Bank, and it's everywhere. I thought it was a better, bigger institution, and somebody said, "Mate, do some work before you make this decision. There's a critical decision here. You're unbelievably lucky. Don't waste it." And no disrespect to HSBC, but I ended up in Goldman because that person made me stand still for a while and then walked me through it. And I was like, okay, great. So that was purely luck, and it wasn't for talent reasons. It wasn't for anything. I mean, you hustle to get those jobs. I think I interviewed 26 or 27 times with Goldman to get that job. It was nuts. Just with Goldman, just to get that job. It was crazy, because you interviewed with, they do things on a consensus basis. So you interviewed with all the team and then quite a lot of HR. And then, I mean, no, it weren't all necessarily interviews, but coffees or whatever you want to call it. But you treat them like that. It was crazy. Interesting enough, I made an internal change within Goldman. You probably won't be any surprise to your listeners, but I was an unbelievably terrible foreign exchange trader. I mean, unbelievably terrible, even after 2.5 years. And I was failing badly, and I'd been tapped on the shoulder as to, hey, maybe time for you to go and look for something else to do. And so I was, and I thought I'd go and do this other thing. And in order to be able to get into the other thing, which is a different story with this thing called sales trading in equities, they one way or other, I ended up interviewing internally with Goldman, which I didn't think you could do. I had similar number of interviews internally within Goldman to make a switch from FX to but anyway, so that's how I ended up in engineering. I empathize with your peers now. I mean, I've got a son. I've got 3 kids, but I've got a son who's looking to get into, he's in internships now. He's just left university a year ago. He's looking to get into a professional job, and just to get to talk to a human is hard. And humans are the people who do the hiring. Like, bots don't hire anybody. They screen fantastically, but it's very hard to get a face-to-face conversation. And depending on the organization, it's also very, very hard to get to one where they're in a position where they can hire, or apart from just refer to the bot to the screen process. It's incredibly difficult. So I'm empathetic.
Yeah. Oh no, well, we appreciate the empathy, because first of all, 27 interviews does not sound fun. I mean, luckily, I don't think that's, as students, we don't have to go through anything like that. But on the flip side, echoing what you just said at the end of that answer, we can't, I don't think, in the student community, or people, recent graduates, can't get on a coffee with someone and hope to get put into a hiring process. I don't think, unfortunately, I don't think that's there anymore.
I think you can, and I think you should.
Do you think?
I don't think it necessarily doesn't, and it depends on the size of the organization. But the getting into the very, very big financial service firms is very structured, for good reason, by the way, because there was a lot of nepotism and all those sorts of things in that world, and it did create terrible biases and things like that against hiring very good people. But you can certainly still do it in smaller firms, because people want to hire good people. So the single biggest risk as a manager is, who do you hire? And when you want to hire good people, you start with some degree of certainty that you build from you leveraging off referrals and things like that. Because if you're referred a very good person because they've done an internship with your firm, in your head, you put a lot of weight on that, because you're just hiring a CV that's got through a bot. You've got very little certainty as to what's that going to be like.
Yeah. No, you are right, especially with the smaller firms. I mean, getting face to face with a professional easier than ever, I think, coffee wise. But yeah, as you said, the hiring process, as you said, it's people who hire. Yep. And for my summer internship that I just finished, the first 3 stages didn't involve a human. Do you know what I mean? It was like online assessments and like CV screening, and then a video interview and stuff like that. But anyway, we digress. But that was a really, really holistic answer. a lot of harsh truths there as well, especially with that internal move, including that many interviews is bizarre to me, but it's what's needed, especially at a firm like Goldman Sachs. But we're going to move on to the next section now. I think that was an amazing first section, and you have kind of answered some of these questions already. But we're going to go a little bit into your career journey through the sell side. So we're going to stick with Goldman Sachs because you spent, I believe, over 20 years there, 20 to 22 years.
22 years.
Yeah, which is a long stint. It's a long tenure. So
Great. I loved
yeah,
all of it. Maybe the last year or so, but no fault of Goldman's. It was just I was at that stage of my career and I was
yeah.
looking for something else. But
Well, exactly. Well, this is exactly what we're gonna get into now. So, over that 22 years, how did you navigate, that career progression? I mean, because you did get promoted. I mean, you worked in different places. You worked in Sydney at a point. So, how did you navigate all those changes and continue to stay in a firm? And then also, what surprised you most about the culture as well when you first joined? I know that's a double-barreled question, but eager to hear your answer.
yeah, okay, well, I'll take the culture first and then the navigation. Actually, no, I'll take the navigation first because the navigation I didn't do. It just happens. I think the reality is, I mean, you've got very, very little control over where you go, in part because, you know, the opportunities don't exist when you're planning. Opportunities, get created along the way. So there was very little sort of, I want to be this in this region or anything like that. I mean, despite, and I think there's a great saying with like, plans are made to be laughed at by God or whatever that process is. By all means, make plans would be my suggestion. But the idea that you could plan your future, and have it turn into reality, within something like a career of a structure that I went through, I think that would be pretty far fetched to think that stuff would come through. Having said that, I'm a big believer in visualizing what you want and try to make those things happen and all those all those sorts of things. And you hear these great stories of people who are 14, 15, sitting down with their uncles or their dads or something, and they turning into the greatest all black rugby player of all time or whatever it is. You hear these. I'm a big believer you can do that, but there's no way in the world I did that. It's just not how it's not how it worked out. I arrived in Hong Kong with a sailing bag on my back, a little sort of whatever it was, sort of maybe a quarter of a cubic meter of volume or something like that, or small. And I left with a 20-foot container and a wife. And I don't mean that to be derogatory to my lovely wife, but I met her in Hong Kong, and none of this was planned. And so to think that my career was planned, it wasn't. From that perspective. Okay, so the culture of Goldman changed quite a lot over the time I was working there. But what instantly attracted me, and this is what I say to my kids, was just the quality of the people. I know that sounds weird, and Goldman has a very different perception, or at least I think it does, from the outside world than to the people who work within it. But generally speaking, the average, quality of person that you worked with was exceptionally high, and they invest very, very, very heavily in the people that they hire. So it's changed quite a lot. But when I first went to foreign exchange, there was, there wasn't any investment in me apart from, working on the desk. But when I moved to equities, there was a sort of time when there was a training program, if you like, in the equity department for what they called associates. So technically, I just joined as a person, but they turned that into an analyst when I was, in foreign exchange, for the purpose of, sort of trying to figure out, well, who you are, who are you and how do they pay you and all those sorts of things. And then when I moved on to the analyst training program, and the analyst training program was a 6-month training program. I'm not kidding, 6 months. I spent 4 months in New York, 2 months in London, then I went back to Hong Kong. Right. And in that period of time, I was being trained. I didn't earn them a penny, and I cost them a lot because they had to put me up in, like, it was nuts. Like, that's a heck of an investment. And to this day, I'm still friends, and I mean good friends with, a chunk of the people who I went through that analyst program with. And they, in that program, it was very, very military-esque in terms of how they thought about it. They took you down to the lowest common denominator. They broke you down as a class so that, I mean, I'm not kidding. I was 27 years old and I was in detention. I mean, it was pretty basic stuff on a Saturday morning. And it wasn't just me, it was the whole class. There were 220 of us. We were all in detention because we left a auditorium messy or something like that. I mean, it was pretty weird stuff. You think, how does this? But what it did was it basically built us into a really strong group of people who supported each other, and then they built us up again. Sounds weird, but it really, really worked. And most of us in that program, when I say most of us, certainly my close friends, we stayed in that firm for minimum 10 years, if not, I mean, it was not unusual for people to be there 20 years. I still have friends there who's still there now. And that was in 1996. So it was impressive from that perspective. And they invested a lot in us. And the expectation was we would then invest a lot into our peers and the way the process worked generically was you could ask anybody anything and they would give you up to 15 minutes. And this was not written down or scripted or anything like that, but they would give you up to 15, 20 minutes, half an hour of time. Absolutely. If I can't do it right now, I'll call you back this evening and I'll give you that time. And that happened geographically. You could call anybody and they would give you that time. And so it was an amazing culture where you could learn and people would give you that time and teach you. So it was fantastic. It's obviously changed because everything changes. The one constant is things change, right? But I believe it's still similar in that essence now.
Wow, I mean, it's amazing and eye-opening as well, because like I guess for a student my age and a lot of our peers, when they think of Goldman's, they would think about this, like, I don't know, in simple terms, a scary firm to work for with their hectic culture. But then like you showing the complete flip side of things is really eye-opening. But then I guess, as you mentioned, there's been a lot of change, so which I think is important for students to know, because I mean there'll be further change after this. So long term, over the next 20, 30 years of their career that they'll have in financial services, it can change a lot, which is, I think, a nice thing for our viewers and listeners to know. But anyways, now one question I had. So of course, you started as an analyst, as you said, and then of course you worked your way up to like uh, MD, then of course regional head as well. So how did your leadership style change of that? Because of course the role must have changed to like people management a lot, I assume.
It did. The big change really was going from being an ED or a VP, which are the same thing, an executive director or and a vice president. They're just different names for the same thing. It's just so the way it worked, I think, is still the same. As analyst program was 4 years. Analyst program, sorry, 4 years. Associate program was about another 4 years, that sort of time. And then if you progress through both of those, they were both ones that you had to progress out of. So there was a process to progress out of them. And then you were in the EDVP population, which is the largest population in most of these firms. And then there was a fairly robust process if you got promoted to managing director or not. And in that process, there was quite a bit of investment in you again, in that process, and then there was a bit of training on, okay, your world is a bit different now. Even though you might not lead people from the perspective of you might not have a team, right? It was quite possible to be an individual and not in your job and not run a team and still be a managing director. But there was an expectation on you that your behavior, stroke, investment, and all these sorts of things would be different. But most of it was leadership was something that you acquired. It wasn't really taught. It's a bit like manners, I think. It's kind of weird, right? You can spend your life trying to teach your kid manners, but they're going to acquire manners by mimicking behaviors of people around them, whether it's yours or other people's. And not much of that is actually actively taught. So it was largely through people who I acquired stuff through people who I worked with, and at the time we had some pretty amazing. I had some pretty amazing managers. I was just either dog lucky or the firm just had very, very good people, which I think was probably more the latter than the former. But our partners who ran our businesses, who would be, you're the analyst or the associate, there's this guy or woman who was, like, you know, careers away from you in your own head, would say, "Hey, I'm taking the whole team, my house, next Friday night," and you go around to their house, and they'd flip burgers for you, make you food, serve burgers, like served to you. You would meet, their partners if they had one, their children if they had them. It was amazing, like, and that sort of process of this was just sort of, and I think in a weird way that held the managers, the partners, to behavioral account insofar as if you go into them and see who their family is and all that sort of stuff, it changes how they behave with you and how they behave with themselves and their peers, in their work process. It's a very strange process that doesn't happen much now within the firm. I believe it certainly broke down in when you get into bigger organizations and all those sorts of things. But that's how it started at the beginning. And I think I just acquired leadership skills through that. Hey, I'm, yeah, I wouldn't, just because you get to a certain grade in a firm does not mean you're a good leader. I wouldn't ascribe to saying I'm a good leader. I may have led, but I don't think I would claim to be a good leader. But what I did learn was mostly through acquiring it as opposed to being taught it.
Yeah. Well, I'm sure the people that you did manage maybe would say differently about you being a good leader, Michael. This has been such...
But some definitely didn't like me, that's for sure. But it's not a requirement to be liked as a leader.
Yeah,
I would argue.
This is also true. I think just a couple more questions on this section. For me, something I really imagine you have a great answer for, and of course, if you can't answer it, then for sure. But what was your most formative experience or deal or project? Something that really kind of stayed with you over your career. Then this could be your whole career, not just Goldman's.
Probably some of the failures. I realize that might sound weird, but the failures are the things that really, really humble you and really hurt and really make you, or certainly for me, really made me knuckle down and that stuff was, looking back, I was probably the most proud of those things too, insofar as not the act of failing, but the fact that you picked yourself back up again and managed to, so and I've got plenty of examples of failures because I think that's true for everyone in life, right? And lots of probably what I mean, there's ones in management, there's ones in direct me as to what you do you want a people failure from a management perspective or a people failure from a practice perspective or what would be helpful?
The next question I had in mind was like about your hiring. How was that? Because of course, as an MD in leadership positions, you were in control of who's on your team, who isn't to an extent. So how was that? And then of course, I remember speaking to another guest about it, that in certain cases, when you hire someone, even through 10 interviews, what you get out isn't really what you thought you hired. So maybe is there any instances like that? Or
the hiring stuff, I mean, it's the single biggest risk you make, but I think it's slightly the teams that I ended up running almost always, I acquired them as opposed to I built them, if that makes sense. So I was either part of them and then it ended up being the leader of that team, or I was moved from one business to another business, or in instances where I moved firms, you sort of move into and you lead a team which already exists. And so you have a very interesting role in that world, as you certainly can make changes, but the changes are harder to make than it would be if you were starting with a team sheet. But I often think of these things like sports. The sports manager of a team often ends up in a similar situation where you inherit a team and then you've got to change it over time. So the hiring was it's not necessarily, you hire to try and make your team better, as well as hiring a specific individual, if that makes sense. So it's slightly different than if you just think of white piece of paper, how would I hire? But I always thought along the lines of there's three major attributes. The first one, and I'll order them later, but the first one is, are they you know curious and smart and engaging and all those sorts of things. Um, that sort of style of stuff. The second one was there's sort of like the integrity, honesty, that sort of side. And then the third one was to do with hustle, the sort of hustle factor, the grit, if you like. How hard are these people? How willing are these people to work really hard? And you need this particularly in markets type businesses. You need people who will run through walls quite literally, because you can't plan for when is there a big, market moving event. When do you have to ask people to not go on holiday? These sorts of things, which are tough, right? But you want people who will just go, all right, if I've got to be here all night, I'm here all night. Roll up the sleeves, and there's no, the people understand the reason you're asking them to do this stuff is because it's needed, on that sort of stuff. The way I would order them, I steal from Warren Buffett, but you order them in grit first, the hard work. The second one is the curious component, and the most important one, in terms of not getting wrong, is the integrity one. So if that makes sense. So the one you have to make sure without anything is that they have integrity, right? Then they've got to be curious, and the grit one is not first in terms of it's the bottom of the list, but it's the one which is critical. The logic behind that is, if you've got the smartest guy who's willing to work the hardest, who's a crook, they'll do the most damage to you, right? So you've got to get no crooks, right? That's number one. Yeah, and I would subscribe to that. That's definitely how I thought about people. I spent much more time on integrity than anything else in terms of trying to figure stuff out, because you can figure, when you're trying to figure that out in interviews and in meeting people and hopefully having a meal with them before you hire them, those sorts of things, hopefully you can get a reasonable idea. And this is why, going back to the hiring bit, in terms of, if you get a referral from someone who, look, this person has done an intern program with me, but I don't have capacity to hire, but high quality person. If I receive that is really helpful if I'm looking. If I get that from my network. So nearly always you would ask your network, have you got anyone who off your intern program, or you're not hiring or whatever. There certainly would be how I would think about it.
Very, very interesting. That was such a brilliant answer. And if for students like us, it gives us check boxes to try and tick at the same time. That's been an amazing section, Michael, and we really, really appreciate it. And I think it's perfect, a perfect segue onto our next section, which I mentioned to you before we started recording, Execution 101. So for students, how do trades actually happen, right? What does it actually mean at the end of it? So I'm going to start off with a really general question, and forgive the simplicity of this, but for someone completely new to the space, what happens between hitting buy on a Bloomberg terminal and then the trade settling?
Okay, so execution, as you're rightfully saying, is the act of transacting, is the act of buying and selling on that sort of process. So the short answer to that is, it depends on who it is, whose order it is. So in the retail world, if you're on an app like IG or one of these, or not that I should use branded product, but if you're on one of these things, it's a very, very different route to market than if you're executing it. That if you're within an institution, usually, like, so how you get to market. But essentially what happens is, the order leaves the order management system, whoever you're hosting it with, so with and then arrives at a broker. It's almost all electronic. And the broker will have a system or a process which, depending on a set of characteristics of the order, is the market open, is the is the market marketable? Is the order marketable? Meaning, is it within the within the market's price right now? So if you're trying to buy something at 90 and the share price is trading at 100 to 105, that order you send to market is going to rest in the market. It's not going to get executed until the share price comes down, right? So it depends on all those sorts of things. But the broker will have a system which will upload the order, verify it all in terms of making sure that it knows what's the stock, what's is it all correct, and then it will route it to usually to an exchange or an exchange like place where the transaction can happen. If there's a fill, that the fill comes all the way back to the client who sees it, and that almost always happens electronically. And then the order goes into the settlement process where we've got to make sure that the money arrives if it's a buy order from the client before the shares are credited to the client's account through the settlement process, the back office process. There's a whole bunch of other stuff. That's a very simplified process, if that makes sense.
Okay, then thanks for the direct insight. But then I guess a direct follow-on question from this would be, then of course looking at the trading floor, then you've got the execution teams, you've got your sales teams, you got your, and of course there's the research team as well. So how do these three teams, I guess, play a part with each other for different trades? And I mean, what's the role of each of these teams together?
So again, it depends on the organization, and we're talking sell side only. So sell side meaning broker, as opposed to buy side meaning the asset manager or the hedge fund, or whatever that process is. The role of the research department is obviously to write research, and usually research is characterized into various different flavors depending on what it is. Whether it be economic to technical and everything in between. But obviously, it's to write research, make it, market it in terms of get it available so that it can be distributed to clients and all those sorts of things. The role of the sales team is to sell it, to sell the research usually, or the technical process. And then the trading business has, which is where I'm sort of more familiar with, has a variety of different sub roles within it. There's the sales group within trading that who sell to the buy side trader, and what they're selling is technical expertise and flow. To sort of make it, or technical expertise is probably wrong, but some sort of insights and flow. And then the traders are pricing, anything which is above market size transactions, and then managing the risk, that results, or they're helping to manage transactions in and out of the market. But there are very few traders who touch order flow in any sort of normal way now, relative to what there was in the past. Almost all of that flow is handled by algorithms, which is a slightly different process. But the traders now, if you go back and look in time, we used to have a trader to sales trader count, which was, I would guess it was probably 5 sales traders to 1 trader or something like that. Now it's probably 50 to 1, something like that. And you can go and look at the stats and find out what that is. But the trader role is very different now to what it used to be.
Well, I'm so glad you brought up not just how the trading world has changed, and I'm sure you've seen that firsthand, but also algorithms. And the reason why I'm glad you brought that up is because I had a question on your own personal opinion on this, but also potentially an example of, does human judgment still beat algorithms? And can you give an example of when it has done in your experience?
I mean, there's no. Yeah, it's man and machine these days, as opposed to man or machine, if that makes sense. If you make the mistake of thinking the machine is always going to win, then I think that's a mistake. And likewise, if you make the mistake of going, well, I'm a human, I should be able to, right? It's man and machine, right? There is no, there's no two ways about it. But so, and you actually can't get to market without an algorithm anymore. Depending on, and by algorithm, I'm not talking about the mathematical definition of an algorithm. I'm talking about basically some automated process which routes an order from a human pressing a button to to get to a market. It's impossible to get to market without one. So that's one part of your question. What was the second part of your question was, how do you beat them? Is it?
Well, I mean, yeah, that's a better question. Let's go with that.
So it's sort of the whenever you code a machine, there's a set of, and I'm not a coder, um, but you're coding within a set of parameters. And one of the things which you try and do when you're coding to execute an order in the market, typically that the time that it becomes interesting is if the client has a very large order, and size by large is defined more in terms of how how big is the order in terms of quantity relative to the security that trades. So, for example, if the order is to buy 100,000 shares of something, and that share turns over 1 million shares a day, then that order is 10% of daily turnover, for that security. That would be considered to be a moderately big order in terms of complexity from the perspective of how do you get that to execute? Because then roughly, 1 in every 10 shares a trade, if you've got a buy order, you need to be buying 1 in every 10 of those shares during the course of the day if you want to get complete today. And so when you get to that sort of size, the there's a series of things which get get very important from the perspective of how do you design that automated process, and how automated should it be without having sort of checks and kick-ins where you have something going, okay, how are we progressing? Do I need to intervene? Do I need to stop it? And all those sorts of things. But the biggest thing I would think in that process is making sure that the footprint that you leave when you're trading in the market isn't visible, or it is as it you look like you're as much the part of the crowd as any other time, or any other person, or any other machine interacting with the order at the time. So, for example, if you were to take your order and always trade, 100 shares every single time, if you start, after about 5 minutes, people will start to realize, oh, okay, there's 100 shares. Okay, we've been going for 10 minutes. There's been, and you become very visible, right? So, it's basically making sure that you don't do things which are very easy to interpret, so that people can predict what you're going to do next, because that's what the game is, right? The role of the intermediary in the market, by intermediary, I mean brokers and market makers in aggregate, outside of the broker who's executing your order. But the role of the rest of the intermediaries in the market is to extract as much value from your order and everybody else's order as they possibly can. And that doesn't mean to say they're doing a bad, there's nothing devious in that. That's just what the role of the market is. Like the purpose of the other players is to extract value from your order flow, if that makes sense. So a long answer, but
Yeah.
the process is, I don't think you can think in binary terms in terms of man or machine anymore.
Yeah, no, that is what I was getting at. Really brilliant answer. Thank you for that.
Yeah, and then I guess, of course, now that there's new things coming up like AI, which I guess put more pressure on the machine side of man and machine, as you said. So if you were a student then coming into, I don't know, Goldman Sachs' trading floor, then what would your approach be in terms of learning market structure or any other technicalities?
If I'm going to turn the question around a tiny bit. If I was, if I was an intern on a trading floor, I would be more interested in trying to figure out how I help the people on the floor, and for sure show curiosity, because, well, I would hope that the curiosity is native in the person, but demonstrate that process, and then whatever they're interested in, you then become. So if you're working with someone who's in the trading business, and market structure is important to that person, how do you go about under understanding that, I mean, it's yeah, I guess it's no different to learning anything. I mean, you know, whatever you can learn from them, whatever you can learn from books, from all those sorts of things. But I don't have a great answer for you in terms of, I don't think it's a trick. You hopefully you're curious, and hopefully the person's willing to share a bit of time and insight into you, and then with that you can take it to go, okay, you know, I always work in the world that there's never a dumb question. You can ask the same question 10 times and it starts to get dumb, but the actual question itself isn't, you know, because nobody knows. You know, I think I know a little bit, but I know a tiny fraction of what there is to know. And so I'm always going to have questions. So everybody else should too. I certainly don't know that much about execution. I've been working in it for 30 years, but you know, I can tell you some very funny stories about how humbling it is to realize that moment where you think you're the expert, and then you realize, oh my God, I know nothing. And that's happened to me very recently. Literally, I said it on that. You know, if I was on a show with Rich McDonald at IG recently, and I mentioned like this week, which was now about 6 weeks ago. I completely humbled by something which I thought I understood, and went, I cannot believe I don't understand this. And I'm meant to be the person who pretends to be the expert.
Yeah.
So the point is that, yeah, we all know virtually nothing. Even the people who think they know something still know virtually nothing about their area of expertise.
Yeah. And I think that level of humility is something that has to be consistent across no matter what level you are in the industry. Obviously, as an intern, knowing that you don't know much about anything, but those two things, as you said, curiosity and then adding value, trying to help as much as you can. And I think to know that humility, knowing that, yes, I can still learn, is still prevalent with someone who's had the tenure you've had in the industry. And I think I mean, even outside of financial services, just humility in general was something that.
But interestingly, I think most people would consider, because this might sound a little bit weird coming out of my mouth, but would consider me to be pretty arrogant. So it's interesting for you to say that that's an example of humility. I've been picked up many times for Mike, tone it down. You're very you come across as very arrogant.
Wow.
Which is a weird one to live with, right? Because I don't like being arrogant, but apparently I come across as it.
Yeah, well, me and Naman say this to a lot of our guests. We say we can tell that there is a sense of humility when you're willing to sit down with two 19-year-olds, soon to be 20-year-olds, and talk about your career. That is humility. It's fine. It's giving up time to teach, in our opinion. So I think there's varying opinions of that, of course.
Hopefully you will do the same thing.
Yes, 100%. If anyone will have us. In 30 to 40 years time. Okay, an amazing section on execution. I know our audience, some of those questions were stuff that I know some of our listeners really wanted answers to, so we really do appreciate that. And I think it's time to move on to a section I'm really excited to get into. So we're going to talk a little bit about Candor Partners and also a bit about market integrity as well within the same sort of section. There's a bit of overlap. So I'm going to kick off with the first question. Again, very broad. That is sort of the theme with the first question of sections. What made you want to step away from the big firms, obviously Redburn, Goldman, and everything in between, and build something on your own?
I wouldn't say I wanted to do it. Would be the first thing. So I worked for a firm called Redburn, and we sold that business to Rothschild, or Rothschild acquired it. Rothschild and myself went different ways. I think if you ask me, I sort of try and dress it up as I chose to leave, but no, I was encouraged to leave, put it that way. So the journey of exiting wasn't all directed by me. I was, or certainly the timing of it, that sort of stuff. Then the reason I set up this firm was related to something that I learned very late in my tenure with Redburn and Rothschild, where again we go back to this expertise thing. So I spent at that point, I think it was 28, 29 years working in securities execution, most of it in equities execution, and so I thought I knew quite a lot. And in that area where you're working with some of the world's largest asset managers, your role is to really try and help them to improve the efficiency of the transacting business from their perspective. And so you're working in, large data, large sums of money, very, very, very low margin business, like not, quite, very hard to be profitable. And I realize that you might be transacting large quantities of money, but very hard to be profitable without extraordinary scale. And the whole game, you're in sort of fractions of basis points of execution quality, genuinely fractions. And in my conversation with the new firm that had bought us, Rothschild, they didn't have an equity execution business or an equity department. And when they acquired Redburn, we sort of became their equity department, and subsequently, since I've left, they've done a whole bunch of other great stuff. They've worked with another firm called Atlantic, and who I think are amazing. But that business, the goal was for it to become the equity department, if you like. And so I worked quite hard with, hard would be probably the wrong term, but did a bit of work with the bankers within Rothschild who wanted to understand how could they describe and package the services of the execution compartment of Redburn to their corporate clients, because Rothschild had largely a corporate advisor for the corporate, and very quickly that focused on building pitch books for or helping them build pitch books, and I'm Olympic class bad at pitch books, to sell the execution services, and for them to be able to sell execution services to corporate. So I asked, pardon my ignorance here, but why does a corporate client need equity execution services? Surely when they're doing transactions, we're doing big, capital raising issues, which are equity capital markets transactions, as opposed to, ECM transactions. So an IPO or a big secondary offering or something like that, which is effectively a block trade, as opposed to executing in the continuous market. So, buying and selling, relatively small quantities of shares in comparison to a big transaction. So, if you do an IPO, you don't typically sell those shares in initial public offer. You don't typically sell those shares that you're just into the market, starting with no volume, and then you go, oh, one share, okay, that's not how it works. You do a big transaction where the company might sell 15, 25% of itself, and that's how it becomes listed. So I was asking this, give me examples of when does a company want to use the continuous market, a corporate client. And it came down to essentially three different factors. One is the company might be looking to try and acquire a stake in another listed company, what you would call a toe hold build or a stake build or something. And that's exactly the same as an investor wanting to buy a stake in a listed company, right? Those transactions are identical in terms of how you would handle them. So if Fidelity wanted to buy a 5% stake in Diageo, or if Anheuser-Busch wanted to buy a 5% stake in Diageo, the transaction process is essentially the same. It's the same problem, so you'd solve it in the same way. The same scenario for a dribble out. So Anheuser-Busch might own, I don't even know if that's still a company, is it? But anyway, might own a stake in Diageo, and they might want to dribble it out. So, i.e., sell it, right? It's exactly the same as Fidelity might want to sell that stake in, right? So they're exactly the same types of transactions. So from a broker's perspective, those are the same things. Then the last one was for corporates to do share buybacks, and that's a similar transaction again. But when I looked at that and I asked them to show me pitch books for what does a pitch book look like for other investment banks or banks when they sell this buyback structure to a corporate, I looked at that product and it was not the same as what you would sell as an execution business to an investor. It was radically different. And very quickly I looked at that and went, well, hang on a second. The frictional cost of transacting through one of these systems, through one of these products, is just it's a different order of magnitude to what it is for investors. And when I say different order of magnitude, we're in fractions of basis points in terms of execution quality, not total cost of executing, but the commission component of the total cost of executing was a relatively small number. We're talking, 5, 3, 5, 8, 10, 15 basis points. A basis point is 1/100th of 1%. And I was looking at some transactions where the corporate was paying, I did a little bit of maths on this, 2, 3, 5, 8%. And I was like, okay, why do corporates end up paying this when investors pay this to do essentially the same thing? So that was the moment when I went, okay, well, we need to look at this really closely. There's an opportunity. So we'll see.
Okay, yeah, that makes sense because of course it's like building something. It's you have to have, I guess, a passion for. And then for us, when we started, it was like we saw an issue as well. We saw that there wasn't a podcast that was directly giving insights to students who were trying to break into finance.
Yeah.
So I understand where you come from. Then, so I guess what surprised you the most about building like a firm in such a like, technical space?
It's incredibly hard, which I didn't think it wouldn't be. So what I've got wrong in my business for sure, and I'm trying to figure out a way of correcting it, is I've got the product market fit wrong, is what somebody would call it from a so the corporate clients who I try and sell my product to, which is a consultancy service, and in my mind, the product which I think is the product which they should want, which they currently don't, but in my mind they should, is if you're a corporate and you're trying to buy £1 billion worth of your own shares, which sounds like an awful lot of money, it is an awful lot of money, but believe it or not, that's the average FTSE 100 share buyback value per year. So last year, I think we had 54 companies did a buyback of the FTSE 100, and the total value spent was £57 billion. So each company bought back about £1 billion. Now, if you're Fidelity or Baillie Gifford or Capital Group or Vanguard or any of these people, if you want to do a £1 billion transaction in one security, you don't just, you give that to your own internal professional trading desk. And your own internal professional trading desk's job, among many other things, is to try and figure out how to turn that £1 billion into the maximum number of shares possible in a risk and cost efficient manner, right? So basically, problem is, how do I buy as many shares as I can, right? That's the sort of, and it's a complicated, it's a simple problem, but it's complicated to solve because the market moves. You can't just rock up and say, hey, today I want to buy £1 billion worth of my company, because it might only trade, £50 million a day. So, but when you look at how corporates do this, they typically go to and buy a structured product from a bank, which is, if you understand the world and look at it through the lens that I look through, is sold by a part of a bank, which is the equity derivatives team. When you go and look at the problem, there's no derivative problem, that you're trying to solve. It's what we would call a delta one or a one delta problem. You're trying to buy shares. Your problem is share price and liquidity. It's a price and liquidity problem. It's not something which is solved by anything in the derivative world, unless the derivative involves a call option to protect the corporate from paying too high a share price, or something along those lines, or selling a put, which means that if the share price gets down to some out of the money put, right? But these packaged products aren't solving that problem. They're not solving price problems. They're solving for something else. And when you look at it, like that, I thought, going back to your question, I thought corporates would go, Mike, yeah, I get it. You understand, how to help us with this process. But actually, when I explained to them, what's going on, it's been interesting insofar as their reaction is more what you could predict if you thought about things from a psychology perspective rather than from a problem perspective. So that bit is interesting, and you forget. I mean, from lesson to me, is you've got to solve problems that people want to address, as opposed to problems which exist that they might not want to deal with. And even though the quantities of money, I think the problem is very, very costly to public markets right now. And so if you look at any of my work, I've gone from what do I think the technical problem is in terms of how to help a corporate to how is that affecting our public markets. And our public markets, particularly in the UK, but this is true in the UK and Europe, are in a terrible position right now. And I think there's some very simple things we can do which will help, not solve, but will help. And it comes back to the share buyback world, just because of the magnitude of the values. And so I can explain that if you want. I think it's really important that people understand this.
Yeah, I think it's just amazing to kind of see kind of your passion for obviously something that you founded is very, very different when you founded something, and a lot of people think it's less work when you're like an entrepreneur of some sort, but it's a lot more. It's a lot more work, as I'm sure you know. But I think you kind of what's the word I'm looking for kind of alluded to it. That's what I'm looking for at the end of that answer. But what would you like to see change across capital markets over the next decade then?
I'm going to be selfish in this then, and just and go. Let me explain what I think the problem is, in inverted commas, and then give you that answer, because the answer is it's a bit selfish from that perspective, or talk in my own book, or whatever you want to call it. So if we just isolate. Now, there's a danger in building models in your head, right? Because you can't isolate the world. But if you just isolate the UK's public capital markets, so by that I mean the listed equity market only, and we just look at that ecosystem, and I just describe it to you very quickly, and then I'll show you where I think that the problem is. So I think that the friction on the capital transmitting through the market needs to be looked at. And so let me just define that by, if you look at the public capital markets and you say, okay, well, every time somebody buys a share from the market, there's a friction, on that. Meaning, if you spend £100, you don't get £100 worth of shares. You get 99, pounds 50 or something, right? 50p of that goes towards, or 50, whatever that would be, £5 of that goes towards the transaction settling, paying for all the infrastructure, paying for the broker, all that sort of stuff. And so friction is you can't get away from friction. It's like friction in the real world. You don't want to get away from friction either. So the goal is not a zero friction world. The goal is a world where the friction in the public capital market in your domain, so in the UK, is equivalent or competitive relative friction in other markets, right? So let me just give you an example and ground it. So we have a public market in the UK which has got about 1,000 companies listed on it in the combination of the London Stock Exchange and Aquis are the two markets which you can list on. But it's about 1,000 companies, and that has fallen. I don't know what the number is, but call it 40% in 10 years, right? Something like that. Last year alone, in the 12 months to December, we lost, I think it was 115 companies net from the market, more than 10%, right? So it's a big problem. And if you look at that in terms of capital flows, we've got about £1 billion. Well, if we're really generous, we've got about £1 billion of capital being formed in the UK, new capital being formed in the UK through IPOs, initial public offerings. So last year it was 780 million, I think, pounds, and there were about 12 companies that IPO'd, something like that. And then if you add in secondary offerings, so an existing company raising more equity capital, that gets to about 15 billion pounds. So that's what I would call capital flowing in from investors to companies, so companies can take that money, invest it in their businesses, hopefully employ people, you and your peers, and do good stuff in the UK. On the other side of the equation, those investors need to get a return, right? Their expectation is they're going to They're going to invest money, buy ownership in a company. They expect to get a return. So there's 1,000 companies which are listed in the UK at the moment, roughly, and they return capital each year in aggregate back to investors. And that capital return process, so capital invested, 1 billion plus, 15 billion in total. Capital return from existing companies is 130 billion pounds. It's a much, much bigger amount of money, as you would expect, because these are companies like BP and Shell, and they're existing companies which are successful, and they've already made all their investments, and they're throwing off capital now, right? So they're returning a portion of that capital to their share. If you want to have a competitive market, so you want to have a market which is attractive to listings, you've got to make sure that it's efficient at creating capital on one side and returning capital on the other side, right? The other side of capital, when you look at how is capital returned to investors, it's returned via two mechanisms. One mechanism is dividends, right? If you look at the UK market, we tax dividends as income. If you look at the US market, they tax dividends as a capital gain. Now, income generically in the UK, let's say it's 40% for high income earners, right? And capital gains is about 20%. In the US, if you take roughly the same numbers, which is not quite true, but roughly, you get the same differential. So they're getting in the US, for the same capital which is being returned from their listed companies, their investors are receiving 20% more, right? That's a very, very, very big difference. Now, in the UK, there's nothing we can do about lowering tax. And there's a bunch of political reasons why, but also just the state of the government, right? There is no money in HM Treasury to be able to make tax cuts like that. And there's all sorts of social questions as to whether that should be the right thing or not. But just bearing in mind, we're just looking at the economics side of it, right? So what you'll see is because of that differential in tax, companies understand because they talk to their shareholders. A lot of their shareholders want to receive capital being returned via a buyback because it's much more fiscally attractive. There's a lower tax way of returning capital. Okay, so what you'll see is IPOs have fallen dramatically, but the only growth area in the capital markets, not only, but the major one has been companies shifting from not returning capital via buybacks, only dividends, to almost half of the capital, which is now being returned, is being returned via buybacks. Right. So there's been an enormous growth. If you go back 10 years, it was 4, 5, 6, 7, 8 billion pounds a year, for FTSE 100 companies. Now it's, I think it was 58, 55, 57 or something like that over the last 3 years, right? So it's been a dramatic growth. So the equity execution of that is really important, that it's done efficiently. And in the UK, it is magnificently inefficient. And that cost, I think, is roughly 100% higher in the UK for companies to return capital than in the US. And so if we want to have a competitive capital market, we just need to be able to transmit capital efficiently from issuers back to investors, as well as from investors to issuers. If you can I'm drawing sort of pictures in circles on my screen, but if I can sort of try and I realize that might be difficult to understand, but we have to have friction because friction pays for financial services fees, right? I'm part of friction. I'm trying to be part of friction, right? So I'm not saying no friction, but you just need to make sure that your friction is competitive with your global peers as a market. Otherwise, you lose investors because their return is lower for the same risk. And if you lose investors, you lose listed companies. And if you look at what's happening in the UK, we're losing listed companies because the investors aren't getting the return for the equivalent risk in our markets versus in others. Sorry, a very long
Oh, it's brilliant
answer.
Very long but insightful, because
it's really important that we solve for this.
Yeah, because the perspective I had was that many companies were going to the States or other exchanges for higher valuations, but then this perspective is
but they're linked.
Sense. It's
an ecosystem. Why does a company trade at a lower price to valuation in the UK versus in the US? Now, there's a whole series of reasons, but you don't trade at a lower price without somebody selling. Who's selling? It's the investors. Why are they selling? Probably because they get a lower return on the equivalent risk in the UK than they do in the US. Why do they get a lower return? It's all linked. Then if you look at what's the solution to that? Well, the only solution to that realistically is find new buyers. New buyers are things tend to make prices go up, but that's a hard thing to do because buyers won't want to invest, or they're investors, right? Unless the return is good. There's a reason why you're trading at a discount. So you've got to attract new buyers through improving the economics for them, right? They've got to get a better return, right? How do you get a better return? Well, we're back in the same place. But the rational thing for a company to do, if their share price is trading at a discount to the theoretical fair value or their peers, if they're the same type of company with the same growth rate, blah, 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 the rational thing for the company to do if their price is trading cheap is to buy it back. Because if you buy shares back, you transfer wealth to the remaining shareholders from the people who sell, right? So that's a rational, fundamentally clever thing to do. But that only works if the capital that you allocate to buying back your shares actually buys enough shares back. If a whole bunch of it, if like 10% goes poof, and disappears into the ether, you're only buying back 90% of, you're only getting shares back for 90% of the capital. That's devastating, but it's not easily transparent and easily measured and demonstrated to the market. So this is what I'm working on, and I've pivoted from working with customers and corporates to trying to work with people who understand that, hey, if we actually make this better and we make this transfer of capital more efficient, it will help improve investor returns, which helps to narrow the discount so that it will attract new companies to the market, because companies don't want to sell their share prices at discounts. Why would they? Right? So they will not IPO in our market until. So the whole thing is linked. It's an ecosystem. And again, I've tried to simplify it, but it's all linked. And it's really important to look at the big picture and understand what's going on. And if we get a healthy public market, then that is good for financial services, because what you hope for is, with a healthy public market, is that it attracts more investors and more issuers, and the scale gets bigger, and then you allow the brokers and the investment manager and everyone to compete in a larger pool for market share rather than in a perpetually shrinking pool. Right, the moment we're competing like dogs with each other in a pool which is shrinking and shrinking and shrinking. Like, for short term, you just want to beat your competitor, but longer term, you all want the market to be bigger. So we've got to think slightly longer term, I think, and it's very hard to do because it's like, you can think of all the sort of sports analogies. Right? If you're in any sort of competitive league, right? Yeah, you rely on somebody outside of the competitive league to basically set the rules, and you just play hard within the rules. And if you cheat, you hope you don't get caught. It's how it works, right? In all sports and in business.
100%. But yeah, that was really insightful because it made me understand the picture. Of course, I'm gonna have a rewatch as well. But yeah, that was really interesting, and I see where you're coming from, especially that link as well, because as you said, it is an ecosystem. Everything ties into each other. But anyways, we are coming up to the end of the episode now. We've got our final section. Michael, you've given us so much insight and amazing answers throughout. So thank you for that. But so our last section is on your plans for the future and maybe looking back a bit and reflecting. So we've got these three questions that we ask to every single guest, and it's always nice to get different perspectives from people who are current analysts all the way to people who have been in positions like yourself. So I'll kick off with the first question then. So looking back on your career journey, what are you the most proud of?
Just the career, as opposed to, because obviously outside of my career, I'm very proud of my family and that sort of side of stuff. But it was strictly just a career. I think it's the quality of the people that I've worked with, in terms of and being able to uh, be a vehicle that they could help, and then likewise be a vehicle to try and help other people. That sort of, it's the it's not the achievements of any one person in like that make people's career. I mean, definitely there's an element of that for sure, but it's being able to partake in that and work with some amazing people. I mean, I worked with just fantastic people in all the firms I've worked with. I haven't mentioned the people in Redburn and in Rothschild as well. Just unbelievably high quality people as a sort of a generic process. The same with Virtu. They're all very different firms, but I've taken a lot more out of those processes than those firms have ever got from me in terms of because they've developed me. So I guess I don't know if that
That's a
answers the
brilliant
question.
answer.
But it's that
Oh no, that is amazing. We actually had a similar answer on one of our previous episodes with an investment banking associate at JP Morgan, and he is in such that he's, I wouldn't say at the start of his career, but he's only had like a couple of years in the space. And so it's interesting to see how, despite such difference in tenures, that is still something that people are proud of, just the people they have in their networks. Next question. So if you could give your younger self one piece of advice and you can choose what age you want to aim for, what would it be if you would give any advice?
It would be be true to yourself, I think, in terms of always honor your own set of values, if you like, and try not to obviously you're going to evolve yourself within the cultures that you work, for sure. I mean, that's how human behavior works. But stay true to yourself, and I think by and large, I've done a reasonably good job of that most of the time. But it would be it would be that process, and also within that it's back yourself, like, which translates to take risk. Like, yeah, the whole process is there is no such thing as a safe job, right? And I don't mean that in a negative way. Everything is a risk, but be comfortable with it. Get comfortable with it and take it and embrace it and own it and thrive from it. Whereas I think I would be probably guilty of being a little bit too conservative in some of the decisions I've made. Um, with the benefit of hindsight, that you could have, I could have taken more risk, and especially early in your career, take a lot of risk. You're going to learn something. The value you'll get from it may not materialize in something which you can use to buy a car or something like that, but it will materialize in something which in future you'll be able to use to buy 10 cars. In that sort of, there is no substitute for experience, and you really only get it when you put yourself at risk, or you get it faster when you put yourself at risk.
Because I just think about maybe just going through something that you put so much passion into and you've stayed true to yourself. The enjoyment after that is just, I guess, on a different level. But anyways, I ramble. So last but by no means the very least, the final question of this episode then for you, Michael, is what is the biggest takeaway you hope our viewers and listeners get from your story?
Pass. I don't know. Your listeners will have to be the judge of that. What I would like them to take away is go and have some fun. Go and be true to yourself. Take some risks, and make sure that along the way you do everything you possibly can to try and help your fellow beings around you, because we're all in this together. There isn't it is not an isolated. It's a team sport. And you're only as valuable to your team as how as how much you can contribute to it, because you'll benefit the greatest from that as an individual, but only because you're working well within it.
Yeah. Oh, for sure. And what a brilliant way to end the episode. And actually, what I hope our viewers and listeners get away from your story as well, take away from your story is kind of go with the flow almost. You've had a lot of inflection points in your career, and you've taken them on, and you've thrived from them, and probably ended up better than you were before those changes. And also, you've mentioned your family a lot through the episode. Keep family close, closer than your career, closer than work if you can, and also play some sports. I think sports has come up a lot throughout the episodes, if you can, and if you're willing to play some sports. But that has been the end of actually one of our longest episodes to date, but it didn't feel like it. It was such an amazing episode. So Michael, we do thank you for your time on behalf of our audience. We really do appreciate it, and we hope you enjoyed it as much as me and Norman did. But of course, for our viewers and listeners, we hope you enjoyed the episode just as much as me and Noman did as well. So if you are watching us on YouTube and for some reason you haven't subscribed already, then I'm pretty sure Michael has given you an amazing reason to subscribe for more episodes of the Smart Money Show. And of course, the same does go for if you're listening to us on an audio platform. And on both platforms, you can leave a like, a follow, and a comment to let us know if there's someone we should be speaking to that we haven't spoken to yet, or a topic that we should be covering on the show that we just haven't seemed to have covered yet. And of course, please do show us some love and engagement on our social media platforms and on our brand new website, where our team of 25 plus interns are showcased, including their articles and reports and other events that we're going to be launching very, very soon. But as usual, thank you so much for tuning in to this episode of the Smart Money Show, and we'll see you yet again next week for another episode with another elite finance professional. Take care, see you then, and please do stay tuned. Thank you.